We are here today with your favorite lender, Anthony Desano, to go over some important information, recent reports that have come out. Anthony, everybody needs to know and understand how to compute all of this data that comes out. I really, really want my buyers and sellers to understand the market and not just say, I'm waiting on the sidelines. Don't do that. Understand why you're waiting on the sidelines and how to really process this data so you can make an informed decision. So, the consumer price index recently just came out, Anthony. So we want to know, they're saying that inflation is doing well and prices haven't changed much since in May. And even though the gas prices went down. So can you elaborate on that part?
Yeah, so the consumer price index did come out yesterday. It was a little bit better, meaning inflation was a little bit better, than it had been. It's a 12-month, look. So every month that they come out with the report, they're eliminating the prior month in 2023 and introducing the new month in 2024. So it's a 12-month look. And so inflation went down a little bit. And obviously that's a good thing for interest rates because when inflation is high, interest rates are high because they're trying to combat inflation. When inflation starts to drop a little bit, interest rates should get better. So we got a little bit, of a reprieve yesterday, rates a little bit better. So obviously that's one of the reports that come out. And there's so many reports that come out each and every day, every week, every month. There's things that come out that cause rates to go up, they go back down. They're up, they're down. And it can drive, borrowers crazy because, hey, my rate is this. And then literally tomorrow, it might not be. And so why? So the question is why? What is going on? Well, look, trading takes place on the stock market every single day. Investors are there. They're putting their money in the stocks. They're putting money in bonds. Where are they investing their money? And that really can change the way rates are in a given day. So what is it that makes this happen? Well, it's reports. It's numbers that come out. And they come out at different points during the week, during the month. But they come out every single month, most of them. And so it's all centered around one concept, the health of the economy. So just to make it very simple, all these little reports that I'm going to talk about, they all talk about really try to drive where are we with the economy? What's the health of the economy? Now, a good economy is bad for interest rates. Good for us. Obviously, we want a good economy, but bad for interest rates. When the economy is slowing, when the economy is weak, it's good for interest rates. So obviously, these reports that come out are going to make investors feel like, okay, we've got a strong economy or we have a weak economy. And they're going to measure it based on these reports and numbers that come out. Now, the other thing that drives rates, obviously, is when the Fed meets and whether they decide to actually raise or lower rates. But that's a direct effect, right? So when they have these meetings, they're going to say, or do nothing. They're going to say, well, hey, we're going to raise rates. We're going to keep rates where they are, or we're going to lower rates. And that's an immediate effect. And so that's obvious. So
and
those
that
meetings.
just happened. He said he's going to hold steady. From what I saw, he's going to hold steady. So they're not projecting any changes until around September, which I agree with. What do you think?
And so not funny you say that, right? So yesterday, when in the morning, CPI came out. Oh, inflation's pretty good. It's looking better. So rates went down. And then 2:00, he says that in the meeting. Guess what? Rates ticked up a little bit from there. All in all, rates went down yesterday. But if you look at the bond market, which is I sent you to, which you can send to all your buyers, the Wall Street Journal bond market, that's kind of one of the things to track. You can see it went down and then slightly up at 2:00. Why? Because all things that are said, it's reports, it's what the Fed says. And it's so funny because that's what I was going to say next is it's not even just what the Fed does. Sometimes it's just what they say. And we've said this before. What if they decide to do nothing, sometimes that has an effect. And so they can say, we're not going to do anything until September. Okay, well, they're not going to do anything. Well, technically, that's in the eyes of people who are investing saying, well, you're not saying the economy's weak, right? So because if you feel like the economy is really weak, you're going to probably lower rates or say that you're going to lower rates very, very soon. And because they didn't say that, and they said we're going to push it off maybe till September, or maybe even November, who knows, rates ticked up just a little bit from what went way down with the CPI numbers, right? So all of these things, and just that's an example of one day, not even a week or a month.
One day.
That's just one day. Here's a report, numbers down, interest rates down. And here's something somebody says, interest these are things that can drive you crazy as a realtor, as a loan officer, as a buyer. So, it's important to kind of know what are these numbers that come out. So, all right. So the Fed, as far as they go and what they want to see inflation hit this number of 2%, which is very difficult to get to. And they're finding that it's very difficult to get to. And basically what that means, that 2%. So the people out there might say, well, what does 2% mean? Well, 2% means year over year, how much has the cost of products gone up? And first of all, products are always going to go up. They're not going to come down. I mean, you might see sales, but it's always going to be that prices go up over time. So as long as the rate at which prices go up is moderate, all is good. But if we were at 8% at one point, and that's just too much year over year, 8% increase in products is just too much for the consumer. So 2% is kind of a more realistic number of where the prices increasing year over year is going to be something more normalized in their eyes. So they want to see this 2% number, and we're at I don't even know, 2.5, 2.6. We're close, but it's going to be very difficult to get to 2.0. And they're starting to realize that now. And that's why they said, the beginning of the year, we're going to lower rates 3 or 4 times this year. And all of a sudden now they're not. And that's because we're not getting to that 2% number that they thought we were going to get to. But the more they analyze this number, they're looking at it and saying, I don't think we're going to get to 2% this year at all. So are we really not going to lower rates at all this year? That's not a good thing either. So what they start doing, at least what they hinted at, is they're going to start looking at some other, rather than focusing so much on inflation, they're going to focus on some other numbers to see what the health of the economy is, to see if they can lower rates based on some other reports. So what they hinted at was looking at the unemployment rate. And to me, to be honest with you, that's the inflation. Inflation's, I don't want to, say inflation's not important, but to me, the unemployment rate means a lot as far as what the health of the economy is. So they said that they're going to start to look at that. Now that went up last month. And
272,000.
Yeah, it's a lot. So
do you believe that?
Yeah. No, I do. I do.
But when did the amended job report? Because the first Friday of every month.
That's another whole thing.
That's a whole other thing.
Get into that. That's the next thing. So you got the unemployment numbers that come out, and so the unemployment numbers come out at the beginning of the month, and so we'll see that in July. And if we see that tick up a little bit, I think you're going to start to see the Fed really focus on lowering rates maybe even sooner than September. If it goes up July, if it goes up again in August, you're definitely going to see them lower rates. So keep your eye on the unemployment rate and seeing if that goes up. Next, the jobs report. So Faith, when does the jobs report come out every month?
First Friday.
First Friday. She knows that like the back of her hand. Why? Because we talk about it all the time. And we've talked about it on this podcast many times. So first Friday of the month, the jobs report comes out. So there's an expected number every month. They start out with, okay, we expect this many jobs to have been created. And then we sit and we wait. And if more jobs were created, well, that's a healthy economy, right? Bad for interest rates. If the jobs are lower than what was expected, well, that shows weakness in the economy, and that's going to lower interest rates. So that jobs report, the first Friday of the month, so critical. It's like D-Day every single first Friday of the month. And I always tell you, oh geez, you know what time it is. It's it's the 1st of June. So when is that first Friday in June? Okay, well, wait for that report. And that report it really, really shoots things up or down. And what happened this month? Well, there's 2 different reports, right? There's one report that comes out on Wednesday with ADP, which is your payroll company, and they do their own measurement, which is not the official measurement. And so ADP, really gave a number that was much lower than what was expected. So rates got a little bit better on Wednesday. And then on Friday, the BLS report, Bureau of Labor Statistics, came out, and that report was much, much higher than expected, and rates just skyrocketed up on Friday. So that again drives you crazy, because you got one report telling you that the jobs that were created were under what was expected, and it's not the official report, it's ADP, so they don't put too much weight on that. But that comes out on Wednesday, the first Wednesday of every month, and then 2 days later is the official report, the BLS report, and that came out extraordinarily high. And we'll get to now what you were just talking about, the amendments. The amendments come out, we've talked about this before. the amendments come out 3 weeks, maybe a month and a half later, and they say, well, sorry about that.
Right.
After digging into the numbers a little bit, we had to pull out these jobs and those jobs. And really, in effect, there was, less jobs created, but the damage is already done
Right.
because it's 3 weeks later and rates went up, and you got these people that are buying homes, and how many closings are happening a day across this country? So you got
Yep.
people locking loans, and okay, great, thanks for letting us know 3 weeks later that jobs report number wasn't exactly. So it's not a very, to say it's not a perfect system is putting it mildly.
Right.
So the
Right.
jobs report numbers come out, and that's those two things. Now, of course, what else you got? You got GDP, gross domestic product, which measures the value of goods produced in the United States. So if the value of a United States product is high, that's good economy. That's going to make rates go up. If the value of the United States product is down, obviously that's going to be signs of a weaker economy, and rates will go down. So that report comes out, I believe the end of the month. So
Mhm.
GDP numbers come out, and that can affect rates.
There's so
And
many
then
things that go into this pot.
it's unbelievable, isn't it? And
It's
so
not everything.
when when you really dig into all of it, it's fascinating. Could be boring if depending on who you are. But if you're
It's very
interested in finding out
fascinating.
why these rates
Yeah.
do this, this is it. And then you've got the inflation numbers, and there's three of them: CPI, which we just talked about, which is the Consumer Price Index; PPI, Producer Price Index, that measures manufacturing costs. So you can CPI numbers measure, the cost of your goods when you go to the supermarket, retail stores, clothing, that kind of thing. And then the third one is PCE, Personal Consumption Expenditures, and that's similar to PCI, but it includes a couple of more things like insurance, rent, housing costs, and things. And the PCE number, by the way, is the number that the Fed focuses on. That's the one that they really want to see hit 2% because it includes more stuff. But you'll have people argue that the other two numbers can be just as important. But so what do you got? You got PCE that comes out at the end of the month. CPI comes out the middle of the month. PPI comes out in the middle of the month as well, similar, very close to one another. So that's three reports that come out that can affect interest rates in the course of a month. And these things are happening each and every month. So during the course of a week, you see
Up
this.
and down, up and down, up and down.
And this is why. So when you're, looking at, hey, Anthony, why did rates go up today? It could be any one of these reports, and it affects trading, and trading happens every day. So
Every
that's
day.
every single day. So
Yeah. So for those of you who want to track these numbers, go ahead and get a subscription with Wall Street Journal so that you can keep track of these numbers that come out, job reports, unemployment, CPI, all of these things in one pot to see how we are driving the market monthly. And that can help you make more informed decisions and understand if you want to help breaking it down, give us a call. Call Anthony, call me, and we can help you really decide what you want to do because real estate is not a one size fits all. It's really going to depend on what you're trying to do. The buyer who is looking for their forever home to retire in is not going to need the same thing in a person who is upsizing for just 5 years until the rest of their kids get out of the house. So it's different things for different people, but you need to figure out how this information can benefit you and give you a chance to make an informed decision, whether you're selling, buying, investing in real estate, whatever it is that you're trying to do. Now, if you're wanting to learn about trading in the bond market, call Anthony. Um,
no,
right. Or someone who does that because that's something else. But
yeah,
it's amazing how it all ties together and how all these numbers are related and correlate with one another. But at the end of the day gonna end. And I think that rates will come down in September. We are in an election year. And I
yeah,
really feel like these numbers, of course, what you said closer to that time, Anthony.
yeah.
But I do feel like they are going to come down a bit, mainly because of that. Because that's another thing to add into this recipe of interest rate is the election. Tell me about your thoughts on that.
Well, I mean, look, regardless of political parties, I think that
Right,
whoever the sitting president is, regardless if it's a Republican, a Democrat,
right,
independent, libertarian, doesn't matter. The sitting president doesn't want to show or doesn't want to be in an election year where the economy looks weak. So this is where I'm going to get into, that Bureau of Labor Statistics coming out with jobs report numbers that seem to be a little inflated, and they'll get revised 3 months down the line. And I think there's a possibility that, during an election year, you don't want whatever president it is to look bad. The people that are appointed by these bodies that come up with these statistics, they're not going to want the person that appoints them to lose the election. So you got to wonder, and it could be, on the edge of a conspiracy theory, but you got to
Right.
wonder
I didn't want
whether
to
or not.
say it. I didn't want to say, who appointed
I'll
Jerome,
say I'll say it
I'm
for
not
you.
going to say it.
Yeah, and again, it's got nothing to do with a political party. I
Not at
believe
all.
that every single solitary political party would be, would want to present that the economy is strong in an election year, because it only looks better for you as a sitting president. Hey, the economy looks pretty good. And who's our president? Well, it's so and so. Okay, great. Maybe we should keep that person in office. So I find it hard to believe that they're going to come out with numbers that make the economy look weak and make the sitting president look bad. Again, whoever the sitting president is. So in an election year, and I've never really thought about it until this time in my life, where what happens in an election. I'm going to watch the next election year. This is going to be top of mind for me. The next election year, will they show signs of a weak economy at all during the course of the time leading up to the election? I think the answer probably historically has been no. But I don't know that to look back, but I'm going to look forward, and I'm going to pay attention to what happens in the next election in 2028, and see if this happens again. And if so, it's definitely a clear sign that you're not going to see weak numbers during an election year. I just feel like that's the case. I could be wrong, but I feel like that's just makes sense.
I agree. I agree. Well, there it is, y'all. That's our opinion. Anthony really broke it down, all of the things that make the recipe for the interest rate. Like I said, CPI job reports 272,000 according to May. CPI holding steady for May as well. And the unemployment rate, Anthony, what you said about that,
It's
and just
increasing.
looking at everything. What's that?
It's increasing. So
Yeah, it's increasing. So just looking at everything as a whole, y'all, that's what we have. And again, our projection is just around that time. Later on, we get into the year, we probably will see a dip then. But as always, what do we always say, Anthony? Regardless, if you can afford what the rate is today, tomorrow, yesterday, if you can afford it comfortably, and you see a home that you like, you see a home you want to invest in, get the home. And then, best case scenario, when the rate drops, you can refinance, right, Anthony?
absolutely, and that's not going to be too far in the future either. That's the best part about it. It's anybody that's buying a home at 7% or 6.75%, they're not going to be sitting on that rate for too long. It's pretty much 2025 somewhere where they will see something in the fives, I would hope, and maybe even refinancing more than once during the course of their 30-year term, and probably more than once within the next 5 years to get into the fives, to get into the fours. God forbid we ever see the threes again, but that probably would take something a little bit longer, like another pandemic or something. But
Right,
you know,
catastrophic.
but these things happen. This is life.
They
These
do.
things happen.
They do.
A war. We don't want to go to war, but
No,
war is a good war. Being involved in a war is good for interest rates. We don't want a pandemic, but the pandemic is
no.
good for interest rates. So, keep your eye on what's going on out there. When you see anything that's a weak economy, or things that are not create unstable situations in the United States, usually rates are a little bit lower. So focus on that, and obviously paying attention to the actual rates that you see posted on legitimate websites, not websites like Wall Street Journal, where you can see some things, and Forbes magazine, where it's not a lender advertising a rate.
Right, right. Okay. So there you have it, y'all. Y'all know how to track it. You understand it. We broke it down for you. Now it's time to get in the game. So give us a call if you need some extra additional information and help. And of course, if you are ready to buy or sell in real estate. Thank you so much, Anthony, for coming on today, and we'll see you in the next one.
Thank
Bye.
you. See you guys.